The 2008 economic collapse, also known as the Great Recession, was a severe global economic crisis that began in the United States in 2007 and lasted until 2009. The crisis was triggered by the bursting of a housing bubble in the United States, which led to a sharp decline in housing prices and widespread defaults on mortgage loans. The crisis quickly spread to other parts of the world, as many financial institutions had invested heavily in the U.S. housing market and were heavily exposed to the risks of the subprime mortgage market. As a result, many banks and other financial institutions suffered significant losses and were forced to write down the value of their assets. The crisis led to a severe contraction in global credit markets, as many banks became reluctant to lend to one another or to businesses and individuals. This, in turn, led to a sharp decline in economic activity, as businesses struggled to obtain financing and consumers became more cautious in their spending. Governments and central banks around the world responded with a range of measures aimed at stabilizing financial markets and stimulating economic growth. These measures included bailouts of banks and other financial institutions, large-scale fiscal stimulus packages, and monetary policy actions such as interest rate cuts and quantitative easing. Although the global economy eventually recovered from the Great Recession, the crisis had lasting effects on many individuals and communities, particularly those who lost their homes, jobs, and savings as a result of the crisis.